Hey guys, do subscribe to the channel if you like the content so that we can provide free resources to the less privileged. So what we're going to be looking at today is the cash flow statement. The easiest way to think of a cash flow statement is what it does is it tracks the movement of cash through your business for a set period of time. And it's all about cash in versus cash out. So we're going to start the data field by something called cash at the beginning. So this is the cash you have at the beginning of a period. Very much like your income statement in the previous video, the cash flow and the income statement captures data for a certain period. So you have cash at the beginning. The next thing that you have is something known as cash receipts. Now, the simplest way to think of cash receipts is any kind of money that is an inflow. So the money that you're receiving is a cash receipt. So if you shipped out a product and if your customer has paid you back, that is a cash receipt. Now keep in mind it's not the same thing as a sale because it's not just an invoice, it's something you've been paid for. So think of money in the register and that's your cash receipt. Now once you receive cash, the accounts receivable section of the balance sheet gets deducted at that amount. So if you get sort of £10 or $10 in cash receipts, $10 gets subtracted from the accounts receivable section in the balance sheet. The third data field that you have is something called cash disbursements. Now, this is the exact opposite of a cash receipt. This is where you have the outflow of cash. So your cash leaves your hand, so to speak. This happens when you pay for any expenses or if you've got money going in for a certain specific reason. So this is basically the outflow of cash. Now, similar to the cash receipts, if you've got money going out for any purpose, the accounts payable section in the balance sheet gets reduced as well. So same example, imagine you're paying out $10 as a cash disbursement. On the accounts payable section, $10 gets deducted on the balance sheet. Now, once you subtract the inflow and the outflow of the cash, which is the cash receipts and the cash disbursements, you're left with something known as the cash from operations. Now, I'm not going to go too much into it because it's pretty obvious. It's the money that you've retained from your operations post any expenses or payouts. So cash from operations. The fifth data field that you have is something known as the fixed asset purchase. Now this goes by many names. It could go as investments or it might just be PPE. The best way to think of fixed asset purchases, if you buy any property or plant or equipment that's going to aid your company in the long run, and if cash is being paid out for it, it goes under fixed asset purchases. The sixth data field that we have is known as net borrowings. Now, if you go out and if you take a loan, that's technically cash coming into your business. So you've received money, right? So it's a surplus. The net borrowings is just any new amount that you've borrowed within the period, subtracted by any payments you've made to a loan or some kind of a debt security, any repayments that you've made. So your net borrowings are basically just any new borrowings or new loans you've taken out minus any repayments you've done. Now, the seventh section that we have is called income taxes paid. Now, we've mentioned in the previous video on the income statements that you have a section that's put out for income tax. I want you to pay particular attention to the income tax paid. Saying you're liable to pay income tax isn't really a cash flow expense because you don't have money going out. If you've paid any income tax, that goes in the cash flow statement. The eighth data field that you have is known as sale of stock. Now, once you sell a stock, you've got money coming in from investors. And again, this is a surplus. Now, the important thing is when you're looking at the ending cash balance, you look at the cash balance you started with at the beginning and post all your expenses and any money inflow, you get cash at the end of the period. So a quick way to calculate this would be your take your cash at the beginning, you add the cash from operations, which is number 4. Sorry, so it's 2 plus 4. Now you subtract any fixed asset purchases you've made, because as I said, once you buy a plant or an equipment, it's money going out of your pocket. So you subtract the fixed asset purchase, which is 5, and you add it with any net borrowings. Again, once you're borrowing some money or you're taking out a loan, that's technically money coming from the bank to your business, so that's a surplus, so you add it. Then you subtract it by the income taxes paid. Once you pay income tax, it's money going out of your register or your pocket or your wallet, or however you want to see it. And then you add any sale of stock, because that's money coming in, and that should give you the total cash at the end, or the ending cash balance. Now there's 2 key concepts that you need to take out from the cash flow statement. Let's just use a different color. Right, so the first thing to keep in mind is a positive cash flow is any time when the cash at the end of the period is higher than the cash at the beginning. So you've retained some cash flow. So in this instance, it would be cash at 9. Cash at 9 would be greater than cash at 1. So you've got that money higher than the amount that was there at the beginning. Now, the exact opposite of a positive cash flow is a negative cash flow. A negative cash flow is pretty simple. It's when the cash at the beginning was higher than the cash at the end. So the cash flow at 1 would be greater than 9. Now, the issue with you having a negative cash flow that's consistent is it shows that a business isn't available to pay out its expenses and costs through cash.